Today, we're digging into a financial report on UiPath's massive Q3 earnings beat, focusing on its surprise jump to GAAP profitability and the big pivot to agentic AI. So looking at this, the report really hammers home the speed of this turnaround. It does a great job covering the good news, that $13 million GAAP operating profit, a first for them, and the really strong Q4 guidance. It paints a very compelling picture.
It does. The foundation is definitely there, and the numbers, well, they speak for themselves. The argument that those AI competitive fears were overblown, the numbers back that up. However, the analysis report, while it details a really powerful bullish case, would be so much stronger if it rigorously addressed the potential counter-arguments to that agentic AI narrative.
That's interesting. I can see what they were going for, right? Projecting conviction by saying those fears were overblown. But is that conviction really earned if you don't tackle the bear case head-on?
It's not, no, and that's the weakness here. The report focuses almost exclusively on the good news, on the positive numbers, and it leaves this major credibility gap by not exploring the systemic risks that are still out there.
You mean things like competition?
Genuine headwinds, yeah, like competitive pressure from the huge cloud providers, the hyperscalers, or even just the immediate valuation concerns that pop up after a 24% stock rally overnight. A truly robust analysis has to show why the bull case holds up in spite of those headwinds, not just pretend they don't exist.
That makes perfect sense. As someone reading this, I want to feel like they've earned my trust because they considered the risks, not just because they, sold me on the reward.
Precisely. So the suggestion here is to integrate a dedicated section, or at least a few transition points, that proactively frame and then refute the biggest risks. That act of intellectual honesty, just showing you understand the skepticism, it lends so much more authority to your conclusion.
Okay, so let's get specific. The report itself highlights the deep integrations with Microsoft Azure AI and OpenAI as a huge catalyst.
Absolutely. And since it leans on those integrations so heavily for the agentic AI pivot, that shift from basic automation to real autonomous workflows, it has to talk about the risk that comes with it.
Vendor lock-in, that sort of thing?
It could be vendor lock-in, or even more critically, the risk that those massive partners just decide to move deeper into UiPath's core business themselves.
So don't just celebrate the partnership, but acknowledge the leverage it gives to a company like Microsoft.
Correct. Right now, it's presented as a pure positive, with no downside. A concrete fix would be to add a paragraph defining UiPath's competitive moat. Why can they win even with Microsoft's own Copilot ambitions growing? We need to really assess the durability of that partnership.
And what about the valuation jump? The stock flew from under 15 to 1850 almost instantly.
You have to anchor to critical valuation context. After a move that sharp, you need to explicitly justify the new market cap. Explain how that $13 million in GAAP profit mitigates past risks and supports higher future cash flow. Just saying the floor just got a lot higher is it's too vague for a serious analysis.
Right, you have to anchor it to hard metrics.
You do. Maybe enterprise value to sales or adjusted free cash flow projections that reflect the new reality. Something concrete.
Okay, that addresses the rigor of the content. Now let's pivot to the structure, how the report is actually laid out. It starts with that really dramatic stock price move. The 24% rip to 1850 is the main hook. The numbers and the agentic AI stuff come later.
Yeah, and I get the impulse for a dramatic opening. It grabs your attention. But to maximize the impact of the core financial story, the report structure should really delay the focus on the stock price and talk about the fundamental business shift first.
Why is the order so important here? Doesn't that huge price move just prove the point right away?
The weakness is psychological, really. By leading with the stock price, you're making the price action the main character of the story. And that kind of diminishes the massive importance of the actual operational achievement. The stock price is the effect, Placing the effect before the cause just weakens the whole logical foundation. The market's reaction should validate your thesis, not be the thesis itself.
So you're saying flip the script, establish the why, the core business achievement, before you get to the what happened next in the market.
Precisely. The suggestion is to reorder the whole thing. Start with the massive significance of that $13 million GAAP operating profit, the big milestone, and the agentic AI pivot. Then you can bring in the stock price action and the analyst upgrades as the inevitable logical outcome.
That makes a lot of sense. If the fundamentals are explained well enough, the reader will understand why the market reacted that way.
Exactly. So, for a concrete example, restructure the intro to focus immediately on the scale of this internal shift. You could even lead with the first-time-in-company history angle for the GAAP profit. That's the real news here. It's way more powerful than a temporary stock price.
And then the stock chart, that massive vertical green candle, becomes the exclamation point on the story you just told.
Yes, you reposition that 24% gain to be the climax. It's the market's required reaction once you fully explain the fundamental changes. This one change elevates the analysis from just, commentary on volatility to a real thesis-driven deep dive.
That shift alone would make the piece feel much more serious, more analytical.
It absolutely would. It changes the report's whole identity.
All right, moving on, let's talk about tone. I have to say, the energy in this report is undeniable. It's exciting, but there are some pretty evocative phrases. Things like smashing through resistance, stock just ripped 24% higher, and Wall Street was caught offside.
That energy is a double-edged sword. It conveys excitement, sure, but the language leans a little too heavily into, let's call it, promotional rhetoric, and that really risks compromising the report's analytical credibility.
But why is that kind of language, rip, smashing, such a liability? It gets the point across quickly, doesn't it?
It does, but for a report that's meant to provide robust, long-term insight, that hyperbolic phrasing can alienate the very readers you want to attract. People looking for sober, rigorous analysis for their due diligence. That kind of high-octane tone, it's better for a trading alert, not a deep dive into fundamentals.
So it's a mismatch of style and substance.
Exactly. When you're talking about a major strategic pivot and structural shift in profitability, using that kind of emotional language, it can make the author sound more like a cheerleader than an objective analyst.
So the core message is right, but the delivery needs to be calibrated.
That's the perfect way to put it. The suggestion is to keep the enthusiasm, but just replace the most aggressive, hyperbolic language with more measured, analytical terms that still get across the magnitude of the news. You can be impactful without being sensationalist.
Can you give a few examples? Like, how do you replace smash through resistance without sounding, totally dry?
Of course, you aim for precision. So instead of the stock just ripped 24% higher, you could say something like, the stock advanced 24% following the announcement, decisively breaking through the previous long-term resistance level. It communicates the same action, but with technical context, not slang.
And what about personifying the market? Like, Wall Street was caught offside.
Yeah, that's a key one to fix. Instead of saying things like short sellers hate or that Wall Street was caught offside, frame it as a technical adjustment. A much better phrasing would be, consensus analyst targets were significantly lagging the reported performance, forcing a rapid upward correction in valuation.
That sounds much more professional. It still communicates the surprise, but it does it with analytical distance.
Right. And that tonal adjustment, it's more than just cosmetic. It's essential for credibility, especially if the goal is to convince serious long-term investors.
So, to wrap this all up, this has been a really useful breakdown.